Ladies and gentlemen, thank you for standing by and welcome to the Centuria Office REIT Half-Year 21 Results Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you need to press star 1 on your telephone. Please be advised that today's conference is being recorded. I will now like to hand the conference over to your first speaker today, Mr. Grant Nichols, Fund Manager of COF. Thank you. Please go ahead.
Good morning and thank you for dialing in to the Centurial Office REIT Half-Year 21 Financial Results and Fund Update. I am Grant Nichols, COF's Fund Manager. Earlier today, we published various documents on the ASX relating to the half-year results, including a results presentation, which we will go through this morning. I am very pleased to share COF's results. COF provides a quality portfolio of highly connected commercial property that has delivered a strong performance through the first half of FY21. Starting on slide 4 with a short overview of COF's manager. Centuria Capital Group is an established specialist investment manager that operates under the ASX code CNI. With around $10.2 billion of assets under management, Centuria Capital Group provides its investors with exposure to quality office, industrial and healthcare real estate investments across Australia and New Zealand, and investment bonds through the Centurial Life business. COF accounts for around 21% of Centuria Capital Group's total assets under management. Slide 5 further highlights the alignment between the broader Centuria business and COF. Advantages of being managed by Centuria is that the group has over a 20-year successful track record in property funds management and a substantial commercial property platform. With in-house property and facilities management, Centuria provides deep leasing capability and hands-on management of the COF portfolio. Centuria Capital Group also remains COF's largest unit holder with 19.9% of the register. The capability of Centuria Capital Group and the strong alignment to COF also provides various opportunities to undertake joint venture initiatives, including potential access to pipeline opportunities for future transactions. Turning to COF specifically on slide 6. COF delivered a solid performance in the first half of FY21, completing a significant amount of leasing while maintaining high rent collections. COF also reduced gearing through challenging but recovering operating conditions. COF's resilient operating performance enabled us to reinstate an FY21 FFO guidance range of between 19.4 to 19.9 cents per unit. FY21 distribution guidance of 16.5 cents per unit is also reaffirmed, which equates to a strong distribution yield of 8.5% based off yesterday's close and a projected FFO payout ratio of around 85%. As Australia's largest pure play listed office REIT, we believe COF provides a quality, highly diversified portfolio leased to excellent tenant covenants. When combined with a solid weighted average lease expiry profile, an average building age of around 16 years, and ample undrawn debt and debt covenant headroom, COF remains well placed to continue delivering attractive income returns to unit holders. Looking at the results summary in more detail on slide 7. The COF portfolio performed well throughout the first half of FY21, generating solid leasing activity, strong cash receipts while maintaining WALE. The portfolio is underpinned by high quality tenants and assets offering affordable rents in locations that resonate well with tenants, especially those scrutinising operating costs and when workforce's preferences show a trend towards working close to home. Additionally, COF benefits from a relatively young portfolio with an average building age of around 16 years. Younger generation stock will assist in attracting and retaining tenants while providing limited overall capital expenditure and maintenance requirements. COF's portfolio COF portfolio's balanced geographic diversification means no single market exposure is greater than around 16%, which is beneficial as we have seen significant variation in the performance of the various Australian office markets. By and large, COF's exposed markets generally outperform the Australian CBD office markets. Looking specifically at leasing, the Centuria team executed a significant amount with over 28,000 square metres leased during the half. This equates to over 9% of the portfolio and has helped maintain our 4.5-year WALE. We've also improved our debt position, with debt being sourced from 5 quality lenders at a very low all-in cost of 2.3%. Following settlement of 465 Victoria Avenue, Chatswood on Monday, which sold at a healthy premium to book value, gearing reduced to 33.2% and undrawn debt capacity increased significantly to $175.5 million, which comfortably satisfies future liquidity requirements. Turning to the portfolio composition on slide 8. We believe COF is well positioned to not only meet changing tenant demands that may be accelerated by COVID-19, but also continue delivering sustainable quality income returns to our investors. Owning a geographically diversified portfolio without single market concentration enhances the sustainability of COF's income returns. Geographic diversification reduces risk to a specific market slowdown, whilst also allowing greater exposure to various industries contributing to Australia's economic positive outlook. In the 12 months to 31 December 21, some of the COF exposed office markets, such as Canberra and Sydney Fringe, experienced positive net absorption, which starkly contrasts the Melbourne and Sydney CBD, which had significant negative net absorption. These are markets where COF has little to no exposure. Over the longer term, we believe there will be a strong employee preference towards working close to home. For some time, we've said a key contributor to employee satisfaction is the length and quality of their work commute. This thinking has certainly influenced our decision to acquire buildings in locations like South Everleigh and Fortitude Valley, with both providing excellent and improving connectivity. While there remains significant concern about productivity related to working from home, there is almost universal acceptance that the most efficient thing in relation to working from home is reducing time lost commuting to the workplace. Consequently, we believe businesses will more actively seek accommodation solutions that provide staff with workplaces closer to their home, providing better commutability. This workplace change will directly benefit metropolitan and fringe office markets that COF is exposed to. We also believe in hub and spoke style accommodation solutions that enhance employee flexibility. However, in contrast to the context in which it is often discussed, we believe it is possible, even preferable, for the hub to be located in metropolitan or fringe locations with a spoke located in the CBD. This would provide tenants with cost-effective, efficient hub accommodation solutions due to the large floor plate options available in metropolitan locations, while it is easy to spoke in the CBD due to the abundance of small suite accommodation already available in CBD locations. We also believe, particularly in times when some markets have elevated vacancy, that there will be a flight to quality office accommodation. Some lazy industry bias may assume a flight to quality would see metropolitan and fringe tenants seek alternate CBD accommodation. While this may have happened in the past, current market data indicates the reverse, with large CBD markets presently recording the weakest levels of tenant demand. In the medium term, we believe tenants will seek improved standards of accommodation and a building amenity, with an increased focus on sustainability, health and cleanliness, including a building's capacity to provide adequate social distancing, particularly in regards to lift usage. As such, we believe there will be a preference towards new generation office stock, which should benefit the COF portfolio as the average building age is around 16 years. Additionally, the portfolio average NABERS energy and water ratings are 4.8 and 4 stars, indicating excellent building efficiency. Affordability will also become a key consideration over the medium term, as economic circumstances force tenants to focus on their operating costs. Again, we believe COF is well placed as the portfolio provides consistently high quality office accommodation at an affordable cost. COF's exposed markets average a discount of between 44 and 67% compared to the Sydney CBD market rents. This relative affordability also makes COF market rents a lot more sustainable compared to our CBD peers. Moving back to the half-year FY20 results on slide 10. COF produced funds from operations of $57.7 million or 11.2 cents per unit and paid distributions of 8.3 cents per unit. FFO increased in comparison to half-year 20 due to prior acquisitions and the Foxtel surrender payment received in July 2020. However, FFO was adversely impacted by COVID-19 due to rent relief claims and other provisions, reducing FFO by $1.2 million. Provided rent relief relating to COVID-19 more than halved during half-year 21 compared to Q4 FY20. CUF's resilient operating performance and the improving outlook for operating conditions enabled us to reinstate FY21 FFO guidance with a range of 19.4 to 19.9 cents per unit. We also reaffirmed CUF's FY21 distribution guidance of 16.5 cents per unit, which equates to a strong distribution yield of 8.5% based off yesterday's close and a projected FFO payout ratio of around 85%. Turning to capital management on slide 11. During the half, CUF exchanged contracts to sell its 25% interest in 456 Victoria Avenue, Chatswood, for $44.7 million. The sale achieved a premium to book value and eradicates any minority interest within the CUF portfolio. Proceeds from the sale, which settled on the 1st of February, were used to retire debt. As a consequence, gearing reduced to 33.2% and undrawn debt capacity increased significantly to $175.5 million, which easily satisfies future liquidity requirements. The interest cover ratio of 7.6 times substantially exceeds the debt covenant of 2 times. With sufficient undrawn debt, a very competitive all-in cost of debt at 2.3%, significant debt covenant headroom, and a diversified debt maturity profile to 5 quality lenders, CUF is well placed with a robust capital structure. Moving on to the portfolio on slide 13. CUF has a truly geographically diversified portfolio of 22 assets without any single market concentration and exposure to most of Australia's major office markets. So for those investors seeking access to Australian commercial property, CUF provides an attractive option due to its young portfolio age, geographic diversification, quality tenant profile, and an appealing distribution yield of 8.5%. Despite the challenging operating conditions, CUF completed a significant amount of leasing during half year 21, securing 31 separate lease transactions across 28,000 square metres, representing over 9% of the portfolio NLA. Of the agreed deals, about 10,700 related to new tenants across 17 separate leasing deals. The balance related to tenant renewals. Occupancy at 31 December 2020 was 91.5%. Occupancy decreased by about 6.5% compared to 30 June 2020 due to the Infosys expiry at 818 Burke Street, Melbourne, and Foxtel surrendering its lease at 35 Robina Town Centre Drive, Robina, as previously announced. Under this agreement, CUF received a surrender payment equivalent to the rent payable for the remainder of Foxtel's lease term, discounted to June 2020. This surrender provides an opportunity to utilise Centuria's strong leasing capabilities to reposition the asset, maximising the benefit of the surrender payment received. Pleasingly, and due to leasing completed, occupancy at 35 Robina Town Centre has already increased to 36.1% during half year 21. As mentioned, the average building age across the portfolio is around 16 years, which further highlights the quality of the CUF portfolio. Newer buildings generally have lower capital expenditure requirements, lower operating costs, and tend to be more attractive to tenants, offering greater building efficiencies and generally better building amenity. During the 2020 calendar year, we actively sought to enhance CUF's energy and water efficiency, delivering improved 2020 NABERS energy and water ratings, and expanding the adoption of renewable energy sources with the rollout of solar projects across the portfolio, such that 26% of assets now produce solar electricity. We are particularly proud of the average NABERS energy rating across the CUF portfolio, which is an excellent 4.8 stars. CUF's portfolio provides a very staggered expiry profile, with 57% of leases expiring at or beyond FY25. This diversified expiry profile is another reason why CUF is able to generate sustainable income returns, as no single tenancy represents more than 7% of portfolio income. Notably, and as indicated on slide 14, CUF's portfolio income is derived from high-quality tenant covenants, with more than 80% of income coming from government, listed or multinational tenants. More than 25% of income is derived from government tenants, with the federal government representing almost 15% of the portfolio income across a number of different tenancies and government departments. Turning to portfolio valuations on slide 15. As at 31 December 2020, 13 of the 23 assets, representing 59% by value, were independently revalued, resulting in a marginal decreased portfolio value of approximately $17 million, or 0.8%, compared to the preceding book value. As a result, COF's NTA as at 31 December 2020 slightly reduced to $2.45. The decrease in value was primarily the result of valuers adopting lower growth rates with increased downtime and incentives. The weighted average capitalisation across the portfolio was broadly unchanged at 5.9%. Consistent with valuations completed as at 30 June 2020, ongoing rent relief claims were accounted for where relevant. Significantly, the entire COF portfolio has been independently revalued since 30 June 2020, and these values have incurred the softer near-term income assumptions made from the valuers resulting from the impacts of COVID-19. As many recent transactions continue to support COF cap rates, if the leasing market were to surprise on the upside, there could be positive future valuation implications, as much of the potential downside has already been factored into COF's independent valuations. Moving to slide 16 and the continuing impact of COVID-19. Portfolio rent collections have continued to improve, averaging 96.7% for the half. By comparison, COF reported rent collections of 92% for Q4 FY20 in the FY20 results, though collections for this period subsequently rose to levels consistent with half year 21. Rent relief claims, both waivers and deferrals, totalled about $2.6 million for the half year. This represents more than a 50% reduction on the relief provided in Q4 FY20. Going forward, as rent relief provisions related to the National Code of Conduct on commercial leases taper, we expect the level of rent relief provided to reduce accordingly. Centuria Property Services and the COF management team continue to focus on the preparedness and rapid response to challenges arising from COVID-19, providing safety and well-being to our tenant community. Looking ahead on slide 18, the outlook for the Australian economy is positive and has materially improved since the full impact of COVID-19 became apparent in mid-2020. Underpinned by significant fiscal and monetary support, the economic recovery is well underway. There's been strong growth in employment, with 50,000 jobs created during December 2020 and the highest level of job advertisements in Australia for the last 18 months. Of the $172 billion in fiscal stimulus committed by the federal government in response to COVID-19, over 85% is aligned to employment and infrastructure. This is particularly important because improvements in infrastructure will make many metropolitan office markets more accessible, but more importantly, the majority of employment within Australia is white-collar jobs. So the continued improvement in Australian employment numbers will generate more white-collar workers requiring more office accommodation. To an extent, this is already starting to become evident as a number of Australian office markets demonstrated improved tenant demand in the fourth quarter of calendar year 2020, as shown in the table on slide 19. Despite this, the table indicates that 2020 was a very challenging period for some Australian office markets, particularly the Sydney and Melbourne CBDs. Unfortunately, much of the commentary around Australian office conditions have centred around these two markets, which incurred substantial negative net absorption and face a significant amount of upcoming supply. Given the overwhelming commentary, some may assume the conditions seen in the Sydney and Melbourne CBD are representative of all Australian office markets, but this is clearly not the case, and there is a wide investable Australian office market outside of the Sydney and Melbourne CBD. Looking at some of the markets where COF has significant exposure, such as the Sydney Fringe, St Leonards and Canberra, we saw positive net absorption, which is in stark contrast to the data generated by the Sydney and Melbourne CBD through the same period. This contrast could be explained by the underlying users, as the Sydney Fringe in Canberra is generally occupied by large corporates and government, but it could also indicate that businesses are more actively seeking accommodation solutions that enable staff to access workplaces closer to home. Another thing to consider when looking at this table is that many of the markets COF has exposure to have relatively low upcoming supply. When coupled with the already significant rental discount to the Sydney CBD, these market rents appear a lot more sustainable, particularly when compared to the Sydney CBD. The improving outlook for Australian office markets, coupled with the significant yield spread between office returns and the 10-year government bond rate, shown on slide 20, generated an increase in transactional activity in the second half of 2020, with several transactions demonstrating robust investment demand for quality office property. Looking at these in more detail on slide 21, a number of these transactions occurred in comparable office markets to COF. When this basket of comparable property transactions are collated, it demonstrates very strong demand for metropolitan regional office assets, as investors recognise the relative affordability and accessibility these markets provide to tenants. The average metrics from these sales illustrate strong investor demand for the types of assets that COF owns, but also a disconnect between the direct market transactions and where listed markets are pricing office REITs, particularly those trusts whose assets are outside of CBDs. Concluding on slide 22, our focus for COF throughout the remainder of FY21 and beyond will be to continue generating predictable and quality income streams. We seek to build Australia's leading pure-play office REIT, positioning it to meet changing tenant demands by providing high-quality and affordable office space. Across our portfolio, we are encouraged by the leasing activity that we have been able to generate and continue to see across our invested markets. This leasing activity gives us confidence as we proactively address any vacancy or near-term expiry risk across the COF portfolio. With quality assets, a robust and diversified capital structure, and support from the wider Centuria business, we believe COF is well placed to continue delivering its strategic objectives. COF's resilient operating performance to date has enabled a reinstated FY21 FFO guidance range of 19.4 to 19.9 cents per unit. COF also reaffirms its FY21 distribution guidance of 16.5 cents per unit, paid in equal quarterly instalments, noting the distribution guidance translates to a very attractive distribution yield of around 8.5%. In conclusion, I would like to thank COF unit holders for their continued support. I will now hand back to the operator and invite you to ask any questions that you may have.
Thank you. Ladies and gentlemen, if you wish to ask a question via the phones, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question today comes to the line of Simon Chan from Morgan Stanley. Please ask your question.
Hi, good morning, Grant. Thank you for the presentation. First question I got, can you clarify that Foxtel surrender payment for us? How much exactly was it that came through the door during the last half?
Yeah, unfortunately, Simon, I'm unable to give you an exact number as it was it's under confidentiality clauses. But I mean, for argument's sake, and it's probably easy for you guys to ascertain what it was in terms of a ballpark figure. Foxtel had a lease through to September 23, and they paid out the bulk of that rent, or effectively all of that rent, discounted to June 2020, and the discount rate applied was about 8%.
Okay, thanks, mate. We can work that one out then. Hey, you like you said in your presentation, you did a fair bit of leasing during the half. I think 21,000 square meters or so. Just wondering if you could talk to some of the deal metrics, perhaps just the highlights, the in terms of the bigger leases. What were the leasing spreads that you had, the average incentives, etc. It sounds like you managed to get a few tenants into Robina, to backfill some of the space, etc. So yeah, can you give us some colour on those bigger deals that you did?
Yeah, thanks, Simon. It's a good question, and it was actually over 28,000 square metres of leasing we completed, representing about 9.5% of the portfolio. And just to clarify, we completed leasing across pretty much all of our markets across Australia. So leases in Hamilton, Fortitude Valley, Robina, Chatswood, St Leonards, lots of leases in Canberra. We completed some leasing in Adelaide, and we also did some leasing in Melbourne, albeit not at A18. So we are generating pretty good leasing inquiry across our entire portfolio, which is pleasing. And considering the amount of leasing we've done to date, we certainly have confidence in being able to address our leasing risk going forward. But in terms of metrics, the leasing spreads that we achieved were pretty good. So the rents were pretty much flat against passing or prior income. We did see an escalation in incentives, but in incentives probably across our portfolio averaged out at about 30% of the net rent.
Yep, but across the portfolio, face was pretty much flat. Did I hear you right?
Correct. Yep.
Cool. Just the last one then. You do have a bit of vacancy to work through, or tenants leaving, right? Docklands, Richmond, I think Brook Street, Marcus Clark as well. How should we think about, I don't know if you classify as maintenance capex or refurb capex, will you be spending a bit of money on that over the next half or next 12 months, or is that not really something you need to do due to the age or the state of the building?
Yeah, so as mentioned on the call, one of the benefits of the COF portfolio is that we have a very young building age, meaning that in terms of maintenance capex, there isn't a lot that we need to do. In saying that, obviously we want to present our office space as best we can, considering that it is still challenging leasing conditions despite our ability to attract tenants to date. So there will be some money that we will be spending on buildings from an aesthetic purpose. So particularly at 818 Burke Street, we are going through a process of trying to improve the building amenity within that building so that we can position ourselves better than our peers in those markets. But overall, there is not a lot of work that we need to do across our portfolio to reposition those assets for us.
Okay, that's fantastic. Thanks, Grant.
Your next question today comes from the line of Tom Bodor from UBS. Please ask your question.
Good morning. Thanks, Grant. I just wanted to sort of ask about your guidance range from an FFO perspective and what's implied in terms of the second half is sort of 8.2 to 8.7. I just wanted to understand what you see as the key variables in that range. Is it simply a question of how quickly you can get those leases executed, or are there other variables in there that you're accounting for in that range?
Yeah, Tom, you're quite right. It's probably easiest to think about it in the two key variables. Firstly, that we do have ongoing COVID obligations, and there is the possibility for continued rent relief support that we will have to provide. So that is one consideration that we have made in providing FFO guidance. But also, obviously, we do have some vacancy within the portfolio at the moment, and it depends on how we lease that up. So I think if you look at the lower end of the guidance, that probably projects that there is very limited leasing completed, and at the upper end of the guidance, there is potential for some leasing to be completed during the period.
Okay, and then within that, sort of the big one is obviously Docklands. And you were in a position where you couldn't really get inspections through late last year. Notwithstanding today's news, how have you come out of the blocks in Melbourne as things have reopened, and has there been good interest?
Yeah, so we've got a few tenants looking at Docklands at the moment. Obviously, the continuing impacts of the pandemic on Melbourne has made it difficult to get strong traction, as there is still not a lot of workers that are back within the Melbourne CBD. But in saying that, we are talking to a number of large corporates and also government users for the space, and that will play out over the half. I think it is also worth remembering that this space only came back to us in terms of Infosys vacating in the very latter half of half year 21. So we've only just got the space back, and we are going through the process now of doing the refurbishment works that are required to present that space in the best possible light. So over the course of this half, we'll not only complete those works, but hopefully we'll start to generate even better leasing inquiry than what we've received today.
Yeah, okay, that's helpful. And then if I just think about the leasing you've done, which I know you've talked to, there seems to be a lot of smaller leases. Is the lease term on those generally shorter, or are there any trends there, or is it sort of just more small leases that is consistent with the larger leases? Yeah, look, I'll probably phrase it that anything under 1,000 square metres, we've probably done average lease terms of between 2 and 4 years, and then anything over 1,000 square metres is probably much closer to 5. There is a general theme throughout office markets that tenants are seeking shorter lease terms. Today, across our portfolio, we probably haven't seen a material change in what
tenants are willing to commit to, but it's certainly something that we'll continue to monitor going forward.
Okay, and then just a final one, more high level. You've got good geographic diversification across all the different states, but how do you kind of view concentration risk? Because we've sort of seen vacancy increase to sort of high single digits based on pretty much two very large leases. Are you sort of changing the way you think about that from a sort of tenant perspective as opposed to geographic, or is there any way you can sort of deal with that?
Yeah, sure. So look, and I mentioned on the call, our largest single tenant exposure is about 7%. Now, in the scale of the portfolio that we have, I don't think that is a particularly large exposure. I think the COF portfolio is pretty well diversified. I think we've got near on 300 tenants across our portfolio, and having the largest tenant at about 7%, I don't think is particularly large. I think when people look at the vacancy rate for COF at the moment, I think it has certainly been impacted by the Foxtel surrender. If that Foxtel surrender had not occurred, the vacancy would not be as high as it currently is. And the fact that we've been well compensated by that surrender, I think needs to be put into the context of where the vacancy rate sits. So I'm pretty comfortable with the amount of diversification we've got across our portfolio. In saying that, it could always be better, but to an extent too, you do want exposure to large tenants, and particularly government, because they do provide a lot of security of cash flow. And I think particularly through COVID, having the COF portfolio 25% exposed to the government has been beneficial.
Yep, no, it's great. Thanks for the colour.
Your next question today comes to the line of Murray Cornelian from Moelis. Please ask your question.
Hi, good morning. Grant, maybe just a bit of a follow-up to some of the questions that have been asked already. Just on both the Robina assets and the Dockland asset, obviously some fairly large or two very large vacations from two very large tenants that have come out in the last 6 months. I was wondering whether you can maybe just give a little bit of colour around your expectations for that space that has been left behind, and then how you see that being filled. Are you expecting it to be predominantly smaller tenants taking 1 or 2 floor plates, or would you be looking to lease out the majority of the space that's been left behind? And maybe just also the nuts and bolts around what needs to be done to that space in order to get it ready for releasing.
Sure, no problem, Murray. So looking at 818 Burke Street firstly, as mentioned previously, what we need to do to that space is purely cosmetic. So we'll be doing a lot of work to improve the amenity in that building. One of the benefits that 818 Burke Street has is that it's one of the few buildings in Melbourne that has immediate water frontage, but it also faces north, so it gets excellent sun and natural light. So there is rooftop capability within that building, and we are building outdoor meeting space, gym space, a lot more building amenity that we think will be certainly attractive to prospective tenants going forward. In terms of the style of tenant that we'll be getting in that building offers a very large floor plate of about 3,500 square metres. So I think at this stage, it is altogether likely that we'll be attracting big users to that building. So I think it's likely that Infosys will be replaced by similar large corporates or government tenants. Now, in terms of the timing for that, we have not forecast any income from that space for the remainder of FY21, and we expect it will be leased up over the course of the next 9, 12, 15 months. In terms of Robina's a bit of a contrast in that we've seen a single building user leave, and I think that building will be replaced by a number of different style of tenants. So that building offers a floor plate of about 1,700 square metres. I doubt we'll see too many tenants enter that building that will be larger than a single floor user, and it is likely that we will also subdivide some floors for smaller tenants. I think the benefit that this particular building offers in the Gold Coast is that a lot of the Gold Coast office stock is probably a lot older than what Robina is. So we can provide higher quality accommodation than what you can get in the surrounding market. So we think we'll be able to attract some of those smaller tenants as they flight quality, as I mentioned on the call, to better style office accommodation. But also I think that we'll be able to attract some of the large corporates on the Gold Coast because, again, we can provide an efficient style of building that they otherwise couldn't get in older stock. So I'm pretty optimistic with where we sit at Robina. As mentioned on the call, we've already completed some leasing within that building, so 2 new tenants are already in that building and operating, and we've got pretty good leasing traction from here. So my thoughts on Robina is that it will be continued to be leased up in a piecemeal fashion, and I'd hope by 30 June we've already completed some of those transactions.
Thanks very much.
And your next question today comes online of Andrew Dodds from Jefferies. Please ask your question.
Oh, good morning, Grant. We've probably already spoken enough about Docklands and Robina, but just one last one on the two assets. What kind of incentives and rental reversion are you kind of expecting on both of those, just compared to passing?
Yeah, sure. So I think, and I mentioned this on the call, I think it's certainly worth considering when you look at the COF portfolio. The COF portfolio rents are coming off a very low base, so I think our ability to sustain where face rents sit will be strong. So in terms of where the rents are compared to passing for both Docklands and Robina, I wouldn't say that the rents that we'll be seeking to achieve, and in Robina's case, the rents that we've already achieved, are materially different to where the preceding rent was. So I think that is absolutely positive for the COF portfolio. Now, notwithstanding that, there has been an elevation in incentives, particularly in Melbourne, but I think that will be incurred regardless of where the face rent of the building's grade or style is. In Robina, thankfully, we are achieving incentives that are lower than what you were probably seeing in other markets, such as Brisbane.
That's great, thank you. And then I guess just one more sort of high-level question, just in terms of some of the inquiry for space you guys are seeing at the moment. I mean, what types of occupiers are you seeing that come from in terms of the industries or types of tenants?
Yeah, to be honest, I wouldn't say there's been like a consistent industry that has outshone others. So we've done deals with mining companies, we've done deals with engineering firms, we've done deals with government departments. So it hasn't. I can't really pinpoint one specific industry that has outshone the others, and it's really been a cross section of tenants that we've been able to transact with.
That's great. Thanks, guys.
Once again, if you do wish to ask a question, it is star one on your telephone. Hi, since we have no further questions on the line today, I will now hand the call back to your presenters.
Look, I'd like to thank everyone for joining today. And if anyone would like to talk further, feel free to reach out to either myself or Tim Mitchell, and we'll arrange a catch-up at a later date. Thank you and have a good day.
Ladies and gentlemen, that does conclude our call for today. We thank you all for your participation. You may now disconnect.